Hello and welcome to the latest quarterly market update with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. So it's been 3 months, Andrew, since our last market update.
yeah, time flies.
It has, yeah. What have you been up to then the last 3 months?
Well, I've been shivering under the duvet, and we had a little visit to the continent, didn't we? See
we
how life is on the other side of the channel. And
Wondering where you were going with that.
yes. It was very good, wasn't it?
Yeah, it was.
A good
nice.
fact-finding exercise.
It was.
And we'll probably tell you more about that in our Christmas special. Stay tuned for that, the C word.
You use that quite often. I like this new Andrew.
That's only twice this year.
Yeah, well. Right, should we go to the markets then and see what they've done in the last 3 months?
I think we should.
So why don't we just do a general overview of the markets then to start, Andrew?
Yeah, so I think for the first time in a long time, the portfolios with the lesser amount of equity exposure have actually performed slightly better than the ones with the higher equity content, as the higher interest rates feed through then into the market which is known as fixed interest or credit market or bond market, whereby we're lending money to companies and to governments. And this has seen an increase over the last 3 months. The equity side has been a bit of a mixed bag. We've seen some growth and then we've seen some money move out of the markets, especially during August, where there was a little bit of a commotion caused by some short trades going a little bit skew-whiff. And so generally it's been a bit of a, not a fantastic month, well, 3 months for equity trades, and a better 3 months for fixed interest, stroke gilts, stroke bonds, which is long overdue. So generally we'll take it. Nothing too exciting, but neither has there been anything too dramatic.
So how's the US doing then?
Well, it's been the best performer in many of the portfolios over the last year, especially the S&P 500, which is doing really sort of great things. One of the funds that we use quite a bit over there has grown 22% over the last 1 year. So we've got the presidential elections coming up. That doesn't seem to be scaring the markets too much. Unemployment remains relatively low, around about 4.1, 4.2%. Slight sort of hardening in the market. There's fewer new jobs being created. Jobs are a little bit harder to get. But it's not really sort of showing any signs of tremendous pressure. The US consumers still holding back a wee bit. The confidence is sort of 50-50 in terms of spending. And generally, companies are reporting reasonably good results. All in all, it's been a good period for America over the last, year, 3 years, 5 years, 10 years, and probably as long as the index go back. Because of the size of the economy, really, it's well sheltered from many of the world's ills, especially the volatile price of energy, with the US being self-supporting and indeed being a net exporter of energy. So they're doing very, very well, really. And I think with the increase in interest rates that there's been over the last 3 years, it's quite surprising how the economy's held up. The Federal Reserve, as we know, they cut the lending rate by 0.5%. And so that created a lot of, I think people had been predicting it, for quite a while. And now they're predicting when the next rate review is going to be and how quickly rates will start falling again. But there's no real pressure, I don't think, on the Fed to cut rates anytime soon. But they don't want to be accused of being late to the party, as they were right at the beginning. So I think on the whole, a very positive view from America, and certainly the funds that we're using within the portfolios and some of the specialist funds have done really well and probably will continue to do so. So a positive period, especially over the last year for the US.
That's the overview of the US. How about back home here in the UK then, Andrew?
Yeah, well, the UK is doing okay. It's not doing spectacularly well, but compared to some of the other developed countries, as they're called, then we're holding our own, if not leading one or two others. I think one of the things we had was the new government shot themselves in the foot within a week or two by saying that the world was virtually going to end here in the UK and there wasn't any point living anymore, which was quite sad because they knew full well what the state of the economy and the finances were. So coming away with this, there's a £22 billion black hole, is don't know where they're getting that figure from, and they've not been able to sort of give us any reasonable explanation where they calculated it from either. So a bit of a funny thing, because it's really discouraged a lot of people from making big purchases, and it's also sort of putting off, I would imagine, a lot of investors into the UK, saying, well, gosh, things are going to get tough, and probably going to get a lot tougher as well over the next year or two. So I don't think you really want to do that if you're advertising UK as a place to do business. But unemployment is low. Inflation is down now to 2.2%. And interest rates, they've come down a wee bit, not as far as we really want to get them. But the good thing that the market likes is this stability within the world of politics, that we know there's not going to be a change of government, all things considered, for the next 5 years. And so therefore, even if it's doom and gloom, we know we can plan for that. So the UK's been, over the last year, it's been good, positive. We've seen some growth now in the FTSE 100, which is well overdue for a bit of a revival. The energy companies have done quite well over the last few weeks with what's going on in the Middle East, and the dividend level that's been paid by FTSE 100, indeed FTSE 250 companies, is really, really good. So you're getting some decent returns there from a lot of the companies. So positive on the UK. There's still sectors that are going to be we'd want to avoid, but there's some good things coming out of the UK. If only the government could adopt a slightly more upbeat and optimistic tone, rather than saying that everything is very, very poor and it's all somebody else's fault. So, but that's what politicians do, isn't it?
Absolutely.
To blame somebody else. It's not. No, it's not up to us. So UK. Overall good story, but could do better, and with a bit of an encouragement, will.
Now we travel, as you like to say, Andrew, across the channel to mainland Europe.
Yeah. So continental Europe, over the last year, it's done very well for us. It's made positive growth. I think second only to the US for many of our funds. There's challenges there. The German economy is still looking to really sort of soar as far as it should. And France is burdened with debt, even more debt than the UK has, and has got trouble now with the government. Germany as well is struggling to try and get its budget sorted out. But elsewhere in the Euro land, there's actually some very good results coming out. Unemployment is starting to come down. Inflation is decreasing quite nicely. The European Central Bank is putting interest rates down, taking certainly a lot more proactive approach than, for example, the Bank of England or even the Federal Reserve, which is good to see. And it's a good picture in Euroland generally, but there's one or two areas that they need to be careful of. Level of government borrowing, and also sort of inclusion as well, that the companies need to be encouraged to do business. So Euroland putting up tariffs against Chinese imports, especially of electric vehicles, is a little bit worrying, because we don't want protectionist measures in the world if we can possibly help it, because it doesn't benefit anybody putting tariffs up, because it just means that the home countries then end up paying more for something, and it sort of creates a bit of a barrier for efficiency within businesses. So I think that's a sort of worrying sign that we're getting more protectionist measures, and with changes in government that could continue, whereas free trade is the answer to growing economies worldwide. So it's been a positive last year for Europe. Over the last 3 months, though, we have seen many of the European funds have fallen in value compared to where they were 3 months. But that's just a short period of time. Longer term, there's plenty of decent companies, decent investments to get involved with. So again, very positive on Europe.
So we've discussed the big guns. So what about the rest of the world? How have they performed?
Yeah, so I suppose we look over to China, and over the last, what a difference a few weeks makes. China's been asleep for most of the year. Having said that, its economy has grown by 3.5% year to date, and we'd love that here. We've struggled to get much above 0.3% growth over a year. But the Chinese economy has struggled over the last 2 or 3 years because of its difficulty within the property sector. Basically, the Chinese built so much property, and in fact too much property. Unlike here in the UK, they went on a building spree, and they encouraged lots and lots of individuals to lend money to buy their own homes, to invest in commercial buildings, other buildings, etc. And then when the COVID came along, they found, oh, actually, we've got too much property, we haven't got enough tenants in it. So there were a lot of people, Chinese, who were ending up with having to pay mortgages or finance and not having any revenue coming in from it. And property prices falling considerably. Well, the Chinese government then, a couple of weeks ago, then decided to stimulate things, lower the cost of borrowing, and also say that the banks need to have less capital behind them, so to encourage them to lend more. The big challenge you've got in China is actually getting the population to believe that and to start spending more of their income. China's got, in terms of being a major economy, they've got the highest savings rate of any economy in the world. They love saving, and the UK saving rate has increased since COVID, but it's nowhere near the Chinese level. So China coming alive again has really helped things. Over in Japan, there's a new prime minister there, and he's adopted a similar policy to the previous one by saying that they're going to keep interest rates relatively low. It's given a boost to the stock market over there. There was a few months of a bit of a wobble, but Japan is back on track with us, which is good. And the rest of the world, well, that's a big place, isn't it? The rest of the world. But there's some really good returns coming out of a lot of countries. Over there in South America, there's decent returns within one or two of the companies over there. Exports as well. The big thing, which always surprises me, is the mining sector is really doing nothing at all. And all this talk about you need lots of lithium and copper for electrification and all the rest of it. If you look at the price of lithium over the last 3 years, it's the bottom's fallen out of the market, which you just sort of wonder what the hype was all those years ago, and even currently, about investing in precious resources. But anyway, generally, it's been a very positive year, a lot better than the year before. The last 3 months or so, the markets are up slightly, and we'll still have a good foothold in the rest of the world because there's some good deals to be had. The big issue, and the one that I'm
the big issue?
Surprised about, is what's going on in the Middle East, which is quite horrible and disappointing. But when we look at the price of oil, if the conflict had happened, say, pre-pandemic, I think oil would be twice the price it is at the moment. But okay, the price has risen over the last 2 or 3 weeks, but we're still down to sort of between $73 and $75 a barrel, which, when you consider at the beginning of this year, some of the big analysts were saying that oil was going to hit $150, $160 a barrel, and that was without a major conflict in the Middle East. So it just shows perhaps oil's losing its power, and alternate energies are sort of helping, and the US being an exporter of energy as well certainly means that it cushions the blow for us, which is good.
And now it's the moment you've all been waiting for. It's time for
the fun fact of the quarter. We're talking about energy this time, and the UK recently closed its last coal-powered power station. We were the first country to introduce them, and we're the first country to get rid of them. Anyway, the region in the UK that pays most for its electricity is...
Oh, you're asking me?
Yeah, go on.
Region in the UK. Edinburgh.
Well, that's not... Okay. It's southern Scotland.
Well, there you go.
And apparently, the average electricity bill for the year is £1,331. The lowest energy bill in terms of regions is in Londonshire.
Of course it is.
And they also have the most insulated homes in the UK as well. There you are. That's the fun fact of the quarter.
As we do every quarter now, we'll be looking at the portfolios and their performance over the last 3 months, 1 year, 5 years, and 8 years. And we'll start with the defensive portfolio.
Over the last quarter, up 2%. Over the year, up 11%. 5 years, up 17%. And 8 years, 53%.
And the cautious portfolio?
The quarter, up 1%. Over the year, 12%. 5 years, 26%. And 8 years, 76%.
And the balanced portfolio?
Over the quarter, up 0.6 of 1%. Over the year, 13%. 5 years, 35%. And 8 years, 102.
And the couple of growth portfolio?
This last quarter, up 0.3 of 1%. Over the 1 year, 13% growth. 5 years, 44%. And 8 years, 125%.
And finally, the aggressive portfolio.
No change over the last quarter. Over the year, up 14%. 5 years, positive 51%. And over 8 years, 148%.